Good afternoon, everyone. Stephen Furness here, Director of MGD Wealth and Chair of the MGD Investment Strategy Group, which oversees all our investment research efforts and asset consultant relationships here at MGD. This is recorded early August 2026, and today it's a pleasure to be joined again by Naasha Kermani, who's manager within the investment strategy group at WTW. And as our listeners would know, WTW is a long-term asset consulting partner of MGD's. Welcome, Naasha.
Thank you, Stephen. Great to be here.
Yes, likewise. Just a reminder for our viewers, this market update recording is designed to be general advice only, so should be taken from a general information purpose only and should not be construed as personal financial advice. As always, we encourage our viewers to seek out personal financial advice if any queries arise from today's discussion. And we invite you to talk to your MGD client advisor in regards to those queries. Naasha, we a few weeks ago now saw the end of the 2026 financial year outcome. So I thought we'd have a brief chat about that, some of the themes that dominated last financial year. But also we continue, as always, every year, continue to have a lot of issues we're balancing in the global and domestic economy. So I thought it'd be good to share WTW views on some of the themes dominating markets in the short to medium term. Sound good?
Yeah, sounds great.
So last financial year, which obviously finished the June 26, like most years, a confluence of some positives and negatives. Obviously, the Iran-US matter dominated markets, certainly in March, but continues to be a theme in markets. We've had the AI investment thematic playing out predominantly in the US, etc. So have you got sort of 3 or 4 big observations to make about last financial year?
Yeah, definitely, Stephen. I think a lot of what we've seen is similar to what you've just summarised there. So as you've just mentioned, 2025-26 financial year was plagued by a lot of geopolitical uncertainty. I don't think that's any sort of secret. We saw geopolitical conflicts and oil price disruption, inflation concerns was also sparked up off the back of that. But what we did see, and I think it's very important to highlight, was that financial markets again delivered strong performance. And what we've really taken away from that was the reason behind it is that there was strong, firstly, economic growth. So economic growth remained resilient despite a lot of the geopolitical conflict that we saw. But then earnings growth was also very strong as well in terms of some of the big companies that we look at across the board. And that really led to strong equity market performance around the world. And as you're mentioning, a situation where markets to some degree looked through a lot of the noise and the headlines that we were seeing and really relied on some of the fundamentals that we're seeing in the numbers, which is always a positive thing to see in the markets and really plays to a longer term investment philosophy of staying invested and looking through the noise, as we always recommend.
Yeah, absolutely. The just on the domestic front for last year, the obviously domestic equity market most people look at a positive year, but compared to certainly global markets, particularly the US, really struggled. We don't have the big AI technology investment base here that the US has. And then budget, the housing downturn, they're the major contributors to why the domestic equity market was fairly disappointing?
Yeah, that's right. And as you mentioned, Australia's equity market did underperform global peers, but I think it's also important to note that performance was overall positive. So around 6% performance in the 2025-26 financial year, maybe lower than historical returns, but still a positive return, which is important to mention. A lot of the factors that you've just mentioned are the reasons that we see behind that. We have seen a couple hikes as well in terms of the cash rate within Australia, which always sort of acts as a deterrent to equity market performance when we do see hikes. But then a lot of sort of the things that you've mentioned in regards to a bunch of changes in terms of the budget, but then also limited exposure to a lot of the global themes around artificial intelligence that we have seen. Also, it's important to highlight that Australia's equity market performance probably has dragged on compared to the rest of the world because of our economic growth hasn't been as robust as well. So if you look at, for example, Australia's economic growth compared to the United States, it's night and day. They have strong productivity gains, resilient domestic demands, and that's overall driven very strong economic and earnings, and then equity market performance. Australia, not so much. So as you mentioned, a multitude of factors which really go into that underperformance for Australia.
Yes, I've got a chart here just to the side of my computer about some of the index returns across the equity markets. The emerging markets, at least at an index level, had a stunning year last financial year. What was sort of contributing to that stellar outcome?
Yeah, so again, as you mentioned, emerging markets, very strong performance. If you take a look under the hood as to what markets have really been driving that performance, a couple that jumped out to me were emerging markets like Korea and Taiwan. And these economies have, as we've sort of mentioned, very large exposure to this AI theme. So semiconductors remain a very large component of their overall index and sort of equity market, because we've seen this really sort of build out in AI, a large part relying on AI semiconductors, which are getting imported out from these emerging markets. They've really benefited in terms of a broader economy, but then also their equity market. So that's really been one of the biggest contributors to overall emerging market strength over the last year.
Yeah, I imagine stocks like Samsung in South Korea.
Exactly.
If you had exposure to that, you've done well. If you didn't, then you might have lagged a bit. But,
that's right. Yeah.
And other sectors for last year, infrastructure, property, just rounding out the performance for last year. Any observations you'd like to make?
Yeah, so global listed property returned around 14.4% in the last financial year, which was relatively robust. Again, if you look at Australia's property market, so for example, Australian REITs, which are listed investment trusts, they actually fell in the year. So really highlighting that divergence between Australia and the rest of the world. And we know Australia's property market has taken a bit of a downturn in recent months. So that's a large part to blame for that. But overall, around the world, these other sectors in regards to property and infrastructure continue to deliver positive performance, which is also great to see in the context of the inflationary pressures that we are seeing. So we know that these asset classes like infrastructure, for example, do perform well in sort of inflationary environments, which can act as a hedge, if you like, to inflation. So always a good asset class to have in portfolios.
Yes, and I've observed in your July market update report that we're lucky enough to receive here at MGD that whole diversification theme still dominates your model portfolio settings, and certainly the global equity exposure versus domestic still a major theme playing out in that model portfolio.
Yeah, definitely.
Yeah. So just in terms of, we're now in early August, just from an outlook point of view, rather than what happened last year. Just domestically, might spend some time on getting your thoughts or WTW thoughts on that housing downturn, the Reserve Bank interest rate settings. I saw last week the inflation number was slightly down, which is certainly what the Reserve Bank's got a major focus on. Where are we at domestically, economic, which then flows on to market positioning?
Yeah, definitely. So Australia's economic performance at an economic growth standpoint, so if you think about consumers, domestic demand, that has slowed in recent months, and that is because firstly, the housing market performance that we've seen, so that's having a drag on wealth, if you like, but then also the hikes in the cash rate that we have seen are sort of having a negative impact on household budgets. And then finally, a lot of this global uncertainty that we're seeing is playing into a slowdown in consumer confidence. So all of that is adding as a detractor to overall economic performance, economic growth in Australia. Employment growth has also slowed, and it's been slower than the Reserve Bank has forecasted. So an overall indication that we have maybe turned the corner and that economic growth is slowing considerably. If you look at the inflation side of the story, which is the other side of the Reserve Bank's target of in terms of their dual mandate, that has been considerably higher than their target range. So they usually aim for core inflation to be around 2 to 3%. As you just mentioned, it did slow in the last quarter to around 3.6% in the year, but still considerably higher than they would be intending for it to be. So an indication that there is still a bit to go in order to get inflation tamed and back to target. And a lot of the indicators that we're looking at is really that the inflationary story continues to be domestically driven. So really it's things like services and non-tradables inflation, which is contributing to a lot of the inflationary environment that we're seeing. And that's ultimately an indicator that the Reserve Bank may need to keep policy rates restrictive for longer. So, we have the cash rate around 4.35% currently. We expect it to remain there for the foreseeable future. So the Reserve Bank won't hike any further, particularly off the lower read that we got inflation. But it's by no means, an environment where they can start cutting soon. So we expect them to pause the hiking cycle, keep on hold for the remainder of the year. In 2027, it really determines where we go. And if we do see the growth side of the mandate deteriorate considerably, so household consumers continue to slow down their spending, employment growth continues to slow, that's the environment where you would see the Reserve Bank having to cut the cash rate into more sort of expansionary territory. If inflation is the side of the mandate which overshoots and is continued to be strong, the Reserve Bank will have to remain on hold for longer or even hike the cash rate further. So it's really an environment where it's data dependent and it's kind of a wait and see approach the Reserve Bank is taking currently.
Yeah, very good. The just on the AI, because you can't get through a day without hearing about the AI revolution, etc. And clearly a very important economic matter for us and impact on investment markets. The corporate gains or productivity gains more broadly across corporate, corporate America, corporate Australia. What's the WTW view on that thematic? Not just data center companies or AI related companies themselves benefiting, the flow through to the broader business community. Have you got a view on that thematic and how it might impact on investment decisions?
Yeah, definitely. So the way that we currently think about this AI cycle is really in 3 stages. So you got the first stage, which was the really, the building out the R&D investments. Then you got the second stage, which is, currently the phase that we're in now, which is the large-scale investment in terms of the semiconductors and the overall environment around AI to really build it out and sort of contribute to the dissemination across the economy. Then the third stage is when you have that sort of second part of the second stage, if you like, really take hold and translate within the economy into productivity gains and other industries, which is very important for this overall thematic to play out fully. Now, our view is that we are currently seeing productivity gains and this dissemination happen more in the United States than other economies, particularly Australia. So the AI gains are being seen in other industries, not just the telecommunications industry within the United States, which is contributing to overall economic performance, given the productivity gains that we're seeing. If it takes hold in Australia and other economies is still very much yet to be seen. So really the ability to go from stage 2 to 3 and see this dissemination from a large amount of investment within the US and just around AI related companies to other economies and other industries is very much the part of the AI cycle, which is uncertain. We do expect it to take hold, but it is going to be a multi-year cycle, and it's not going to be something that's going to show up in the data immediately, particularly for Australia. So that's the overall sort of thematic that we are seeing. So it's very much still centered in the economies that are very much exposed to the AI investment for now. The second half of it is very much yet to be seen, and something that we have to just rely on the data to see whether it takes hold in Australia. Yeah. We do know that in Australia, productivity growth has been very slow, and we could do with a bit of a bump from anything really, and AI investment and technology could very much help that, but it's very much yet to be seen as of now.
So Naasha, just in sort of wrapping up the outlook for the next year or two on markets, taking sort of a diversified mindset to portfolios. Have you got 2 or 3 other themes? We've talked about the housing and local inflation issue. Have you got a couple of other themes that sort of dominate WTW thinking at the moment for the outlook?
Yeah, definitely. So, I mean, the themes that we have for the outlook are very much related to the themes that we've seen over the last year. So, firstly, we expect macro resilience to remain a key factor going forward, particularly in some of the major economies that we look at. So, the United States is the big one. So, we're expecting policy settings in terms of the fiscal environment to remain supportive, domestic demand to remain robust as well, and then obviously the ongoing AI driven investment to really boost macro resilience within the United States. But also we are looking at other economies like, as for example, Japan and China, where we expect above consensus growth within those markets. Another thing that we're really looking at is earnings growth. So I've mentioned the fact that earnings growth has been very strong. We're expecting that to continue as this sort of cycle takes hold, and these the big tech companies really start to show their strong earnings continuously, but also we're getting the broad-based gains within different industries. So if I, for example, talk to the recent earnings results that we've seen in the second quarter of 2026, what we've seen is that the breadth of earnings gains is really broadened now, and we're expecting that to continue. So 8 sectors, not just information technology, have performed double-digit earnings growth in the year leading up to the second quarter of 2026. That's considerable, and we're expecting that to continue. And overall, these are the factors which are really playing into our pro-risk stance in terms of a constructive view on overall markets. What I would say to that is that we have to be honest, and geopolitical risks do remain, and they are a theme that we do foresee is going to continue into the near future. So we have the environment in Iran that's very much unstable, if you like. It's very much hard to tell where that's going to end. We do expect it to sort of be resolved again, as we did when it first flared up earlier in the year. We're expecting there to be a resolution in the sort of near future. So that will hopefully sort of add to sort of overall confidence within markets. But then also what we are seeing is another theme is that overall inflation is playing a larger part in more economies around the world. So in 2026, we have had this re-acceleration in inflation, if you like, not just in Australia. Australia has been the market which has seen the biggest, inflationary impulse, and off the back of that, the largest amounts of hikes from the Reserve Bank. But we are seeing an environment where other economies are hinting at hikes to their interest rates as well. For example, the Federal Reserve has hinted at it, the ECB, the Bank of England, for example, they're all seeing a flare up in inflation and hinting to the fact that hikes are necessary to tame this. So another theme which we're looking at going forward.
Yeah, very good. Well, there's
a lot there.
always lots to manage, and that's and just wrapping up. One of the from an investor governance and investor oversight and fiduciary. That's what's important to MGD on behalf of our clients is having experts like WTW, your colleagues, helping navigate the investment markets and portfolio implementation. So we see it as a vital part of our investment philosophy here at MGD. Naasha, well, we could talk for ages, but appreciate your time today. And just a reminder about general advice matters only, and we welcome your inquiry through our advisory team if any issues arise for you. So thank you, Naasha, and we'll chat again soon.
Great. Thanks, Stephen.